morning, Morgan Stanley downgraded the entire real estate investment trust cohort because these are bond market alternative stocks that could get a lot less attractive when the Federal Reserve likely raises interest rates tomorrow, something that pretty much everyone's expecting. However, they also recommended a few places to hide in this environment, pointing out that some REITs could work even better with higher rates. Doesn't matter. I'm talking about the data center REITs. That's what they singled out. These are the fastest growing themes out there, and the business of owning the real estate under them is a pretty good one. Many people always said, how do I play data centers? This is it. It hasn't stopped the data center REITs from selling off, though. And in the last 6 months, it's been difficult. Which brings me to Digital Realty Trust, DLR. It's a company that owns and manages 156 data centers across 11 countries, 4 different continents. And look, there aren't enough data centers out there to meet the demand from businesses that want a secure place to store their digital information, particularly now that everyone's embracing the cloud. Whenever you hear that some piece of software is in the cloud, what that really means is it's in the data center. And that's among the reasons why Digital Realty has been buying up these properties hand over fist, including nearly $1.9 billion in acquisition of Telx last year and a purchase of 8 European data centers from their competitor Equinix over the summer. Plus, this is a growth REIT. They reported a robust quarter end of October, 25% growth. Wow, that's how strong this data center business really is. Of course, Digital Realty still sports a 3.6% yield, makes it a bit vulnerable to a rate hike. However, the stock's been holding up a lot better than the rest of the sector. It may be down 14% from its highs in July, but it's up nearly 30% year to date, and it's been rallying pretty hard over the past week. So let's take a closer look. New name for us, Bill Stein, CEO of Digital Realty Trust. Learn more about his company and his prospects. Mr. Stein, welcome to Mad Money. Good to see you, sir.
Thanks, Jim. Great to meet you.
Have a seat, Bill.
Thanks for having us on.
Okay, Bill, there is a chart that I have. It's a total return since Digital Realty IPO from 10/28/2004. You have a total return of 1,223.8%. Why are you doing so much better than every single REIT that I follow?
Great question, Jim. It's really because of the demand drivers for our business. So at the present time, there are roughly 3. Cloud has obviously been a huge driver of our business. Social networking from many years ago has been pushing it up, as well as content. But looking ahead, I think there's a tsunami of data coming our way that's going to further drive our business.
And the demand still strips the supply, even though supply has been robust, right?
Absolutely. Demand is ahead of supply. And if you look at what's going to drive the data growth of the future, you've got the Internet of Things, which is, Cisco's estimating 50 billion devices by 2020. Driverless cars. It's going to use a huge amount of data.
Oh, driverless cars would use the data center. How would that work? So for our people who are trying to understand where you fit in something like that, because Google announced Alphabet's going to spin off its driverless car division, so it's really in the news.
Right. So, I mean, Uber obviously is very active in that. They're basing their driverless business in Pittsburgh using Carnegie Mellon's former professors, and they're actually a very good customer of ours. So if you think about the radar and the sonar and the mapping and all of that, their estimates of that a driverless car uses 3,000 in 8 hours uses 3,000 times the amount of data that a person uses in a single day.
So therefore, we need many more digital realty farms, so to speak.
You're going to need a lot more data centers to support driverless cars.
Now, why would I, if I were some of your clients here, Facebook, LinkedIn, IBM, or JP Morgan, why wouldn't I have my own buildings? Why would I want to lay it off on Digital Realty?
Well, you may well have both.
Okay.
I mean, it's a hybrid portfolio approach. But the advantage to using a company like Digital is, first of all, time to market. If a company such as one of the ones you mentioned wants to do it on their own, they have to find the land, which takes time. They have to entitle the land with the local authorities. Then they have to find power for the data centers. They may well have to run fiber to the site, and then they build the data center. That could be upwards of 4 years. So we're going to have an entitled site with power and fiber and frequently a shell. And if we have the shell, we can put somebody in business basically in 90 to 120 days.
Is there enough space for you to do all the farms that you need? I mean, I know that you're fitting one in Chicago. You've got some in California, but I'm just trying to get a sense of whether you need a lot of space.
We need a lot of space. We need, but we have secured our supply chain. We've bought a lot of land in Virginia, in Dallas, and in Chicago to secure our supply chain. And in parts of the world like Asia, we build up.
Okay.
So we have to build vertical because land is scarce in those
Well, I
parts
think
of the
you're a
world.
great growth story. I know the cohorts come down, but you've been much stronger. I agree with Morgan Stanley. This is the REIT that you should own. That's Bill Stein, CEO of Digital Realty Trust. We've profiled the company before, but this is the first time for Mr. Stein. Mad Money is back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.